Hi, this is Eric Boyce, CEO and Chief Investment Officer for BKA Wealth Consulting, and welcome to Charts of the Week for April 26th of 2021. Please see our disclaimer for important information. Well, in our COVID tracker for the week, we see the trends that have been well entrenched over the last several weeks continue to play out pretty much for the most part. Continuing downtrend in the 7-day moving average of daily new deaths, a byproduct of increased vaccination amongst the population. Good development here. We can see a beginning of rolling over here in the 7-day moving average of daily new positives. So all the data here continues to look positive. We obviously want to continue to see that 7-day moving average of daily new positives go down, but we're vaccinating a lot of people every week. And literally this weekend, we got news that CDC is going to allow the J&J single-shot vaccine to be reintroduced to the market after a brief pause to study some of those handful of side effects. So anyway, positive news here. Here's our high frequency data provided to us by First Trust, and really not much change here. It's interesting to note that the open table numbers for the restaurant industry seem to have tracked a little bit negative over the last month. It seems to be kind of an up and down, but the bias is clearly positive. You can see a lot of anecdotal evidence of the reopening of the economy on a gradual basis. You see a lot of areas in the country that are still relatively closed, but those are becoming fewer and farther in between. By and large, TSA checkpoint data has been positive, even though maybe a little bit negative for the last week. Commercial flights, kind of the same story there. But in terms of manufacturing, we've got some commentary on that. Rail car traffic, we've got a Baltic Dry Index, basically a trade and freight indicator, which is really positive. And I'd say overall, we're looking really good on all of these numbers, regardless of how little or how much noise you get in any one particular week. Here's our vaccine doses administered by type. Again, as I just mentioned, the J&J vaccine is now being reintroduced to the market, so we'll have J&J flowing again. We have a total of almost 216 million doses administered, and I think the country is very much on the track that we had anticipated literally two and a half months ago when we were talking about the rollout of the vaccine, that by the end of May, that there's definitely going to be a shot for everyone who wants one. In fact, we could be dealing to some degree with a glut of shots. And I think the issue is going to become more pronounced as to trying to corral those folks who are either undecided still on taking the shot, or even those who have said that they won't take it. But again, every passing day we add more to the body of knowledge on not only what the side effects are, but the long-term effects and things like that. We're building a lot of data plant for this going forward. Here's our total COVID-19 vaccine doses administered, and then the 7-day moving average of that. And so what this really tells us that by and large we're tracking in an upward direction. Again, this number dovetails with the number that you just saw in the by type categories. So we're tracking well north of 200 million doses right now, and generally speaking, it's been a fairly linear fashion. Well, we get into some economic data. This is something that we've been talking about for some time. Is the manufacturing numbers. This is manufacturing index from the Kansas City Fed. So this is in their particular region, but it represents really a kind of the breadbasket of manufacturing. You think about heavy industry in Illinois and in Wisconsin and in some of those areas. I mean, this is what the Kansas City Fed is tracking. You can see the numbers are exceptionally good, not only for an index for manufacturing production. We know that manufacturing, even though it represents a smaller percent of the total economy, is nevertheless very important for labor. It's very important for the stability of our economy, even though services represents a much larger number here. But these numbers are clearly positive and indicative of an emerging economic trend. Now, continuing on that thread, we have also from the Kansas City Fed, we have prices paid for raw materials. And then that's in the upper, and the below is prices received for finished products. So, this is more than likely on a manufacturing side. These are prices received perhaps from OEMs that are purchasing goods of intermediate production, or it could in some cases be finished product that is actually going out to the end consumer. And what you see here in both cases is that those numbers are really going higher. The other read through on this is that you see in, looking at the upper part of this and the lower part, you can see that producers are getting some pricing power back. That's something that is honestly, if you look over the last 20 years, has been an enigma because producers really haven't had a lot of pricing power, and that's why even though when we get these bouts of manufacturing input cost inflation, it's not been passed on to the end consumer. We've really not seen a whole lot of consumer level inflation. Well, at this point, we are beginning to see some of that transmit through. We know the CPI numbers of late have been a little bit higher. We do think that they're going to settle in higher than they have been, but we're seeing a burst of inflation that's kind of really manifested in this chart right here. That is now kind of playing itself out. A couple of categories here. I did have a chart that I was looking at that I didn't include. It's just really the agricultural basket, and then there's like a general commodity basket that comes with it. And so if you just look at ag, I didn't put the corn chart in here, but the corn looks very much like this ag chart, the Bloomberg Agricultural Spot Index. Suffice it to say, the prices for a lot of these goods, steel rebar, this is basically imported steel rebar from China. Prices are going through the roof. There's so much of this in the pipeline that is building. It actually is fairly impressive from a statistical standpoint, but it's very indicative of an economy that's accelerating faster than the manufacturing base can keep up. I mentioned this earlier. This is the Baltic Dry Index. This is a freight index. It's a global index, and it's really a reflection of what's going on in the global trade sector. And the good news is that you can see here that that's spiking up. So again, a synchronized recovery, even though the vaccine rollout has been very clunky in some areas. We're beginning to see a little bit more traction on the vaccine in Europe. So Europe is picking up, and Europe, I think in many respects lags the U.S. by, perhaps 9 to 12 months. So as we've seen the reopening in the U.S., as is typical, for Europe to begin to accelerate a little bit later, I think that trend has just really been maybe exacerbated by the fact that the vaccine rollout's been not nearly as efficient in Europe as it has been in the U.S. But nevertheless, these numbers are really strong in terms of its reflection on the health of global trade. I saw this from the AEI Housing Center. I thought this was really interesting. So, we talk a lot about speculation, froth, liquidity in the market, and those things are all very, very valid. But here's a manifestation of that excess liquidity. When you think about, real estate as an investment class, again, you've got equities, you've got fixed income. Those are the things that at BKA we're extremely familiar with. But we do have a lot of clients that have real estate, and this chart really kind of drives home the fact that a lot of people are looking at real estate now. Prices are going up, and there's other factors which we'll discuss in a second. But really, what this represents, if you can read along the left-hand margin, it's basically share of purchase rate locks. So these are intentions to get mortgages on residential real estate. And at the top, you've got second homes. So the intention, people that are investing in second homes and getting mortgages on second homes. If you look at the trend line, basically 2020 and then 2021 or excuse me, 2019 and 2020, you see a fairly discernible trend, but towards the end of 2020, you really saw a spike in activity on second homes. And then if you look at the blue line, which is obviously, up to the most recent observation of this data, is tracking a lot higher than it was either of the last 2 years. And the same goes for investors, which, they're similar, but yet they're different in the sense that, a second home is something that, an owner would ostensibly use at some point, whereas an investor, this is purely for a rental, purely for speculative growth, even if they're not going to rent it. And in each case, you see that the interest level of investing in residential real estate is much higher than it has been either of the last 2 years. And so why is that? Now we kind of examine what are the reasons why residential real estate is really coming to the front as far as like an investor asset class of choice. And you can see here, there's several reasons from the SCE housing survey that kind of give you some insight into that. So higher housing returns, that is really almost a push. You can see, the kind of the brighter bar represents the current year, February of 2021, whereas the blue line represents February of last year, which is really on the advent of the pandemic. And you can see that there's, more, the respondents to the survey feel like housing has higher housing returns. More people feel that way this year than did last year. Slightly more people feel like housing prices are less volatile than the equity market. Clearly, saving from rents being sufficient to cover costs is not as widely thought of as is locks in housing costs. So what's interesting here is that you do feel, that the average investor feels, even though we've had this huge run up in equity prices from really, March, the end of March of last year, that a lot of people still feel like housing is going up at a faster rate, more predictable rate, and a less volatile rate than equities. So just interesting data here. The median cost of purchasing a home as a percent of family income is something else that I was curious about and came across some data here. And what this tells you is that we're not out of line. Of course, we had that bubble environment that lasted really from 2005 to 2007. And those are clearly depicted in these green lines here in the upper band. We did get carried away. There was froth in the market. There was liar loans, and people that didn't need to be getting mortgages were getting mortgages. And so it really skewed these numbers of the cost of a home relative to one's income, because in a lot of cases, people weren't even being screened for their income, which is kind of crazy to think about, but it did happen. But, as we look at where we are now, I'd say, from a kind of a line of best fit standpoint, we're higher than that average if you look over a longer time, but we're not out of line, which is really interesting. And a lot of that has to do with the fact that the average household is in a much better financial condition than they were, even last year, and perhaps, certainly over the last 5 years from a trend line basis. Now, here's a couple more charts that I thought were interesting with regard to residential real estate. One, we know that we've seen after a fairly brief but kind of a violent upturn in interest rates, we've seen interest rates kind of level off. And so what that's done, especially on the 10-year Treasury, which we have an update on when we talk about fixed income here in a few minutes. But as you see the 10-year Treasury rates kind of roll over a little bit, so too do you see the 30-year mortgage rate, which is tied to that 10-year Treasury. And so affordability has improved a little bit, even if prices continue to go up. But at least the mortgage rates are gone down. They're down now below 3%, which is something that we haven't seen for probably about 30 days or so. And then on the right-hand side, a really interesting chart. Now, what you're seeing is a tremendous withdrawal of equity from homes. You've seen a lot of refinance activity with cash out, and that's depicted here. And so, and this is helping household balance sheets considerably, taking equity out and paying down debt. So you're getting high interest costs on it. I mean, households are kind of optimizing their balance sheet, if you will, by taking some of this equity out. And then there's, by and large, an expectation that you're going to see continued rise in home values that really almost justifies the reason for doing this in the first place. Used vehicles. Now, this is really interesting. So, we know that the new vehicle market has been challenged by supply choke points and constraints. We know semiconductors are in short supply. We've got a chart on that. But as a result, so there's not as much inventory of new vehicles on the market right now. And as a result, there is a lot of interest in used vehicles, and used vehicle prices are extremely high right now, and that's depicted in the Manheim U.S. Used Vehicle Value Index, which is taken an extraordinary jump after falling during the pandemic. But you look at it from a relative basis year over year, and it's really in a different territory now. And what's interesting is that you see a lot of interest in financing of vehicles. You can see this, consumer loan number. If you look at it from the pandemic, it's really struggled to recover. A lot of folks have received stimulus money, and so that green line depicts or reflects this whole notion that people have gotten stimulus money. They really haven't needed to take on personal debt, and so they really haven't. So that number hasn't tracked higher, but a lot of people, have gone out and bought new cars, again, contributing to not only new car prices moving higher, inventory shortages because demand is so strong, but also this situation we see on the left that used car prices are through the roof. And you can see that there's been a tremendous interest in automotive purchases here at the consumer level. So this is a quick chart on the semiconductor issue, and I think this chart on the left really just sums it up. It's the lead time for semiconductors for U.S. manufacturers. Now, we know that the U.S. is less relevant than it used to be, and that's clearly depicted in the right-hand chart. But you can see here that the lead times have really extended out. So, think about all the consumer electronics that need semiconductors. Obviously, we just got through talking about the automotive industry. So many sensors, so many chips that do a lot of different things. There's so much of the automotive business is now computerized, even though it may not look it when we get into a car. But that's clearly the case. And in a lot of other areas, we see choke points having been developed because of this very issue right here. And it's going to take us probably, from everything I've read, somewhere between 12 and perhaps 18 months to kind of work itself through. Now, the chart on the right is interesting because it shows, as we continue to watch with intrigue these trade tensions between the U.S. and China, and the posturing that's going on. And China is becoming a much more relevant player in the semiconductor market. And obviously, if you look down there and you see in the blue, you see Taiwan, which we all know in our geopolitical readings is now, look at China's imperial ambitions, if you will, and it begins to draw some, perhaps some concern, at least for the time being, some relevant note that China and its influences potentially, could be a really dominant force on the semiconductor industry for years to come. We'll talk about the equity market. This is the AAII U.S. Investor Sentiment Bull Bear Spread, and we've shown this to you before, but I'm not sure that we haven't seen this level in a little while. It did spike. We've kind of rolled off that spike, but the sentiment just continues to be exceptionally bullish in the market. So I found this in a chart pack from FS Investments based out of Philadelphia, and I thought this was really interesting because we've had a massive recovery in earnings for the S&P 500 index. I mean, much faster than anybody would have expected. You know, if you look at the orange bars here and you look at different um, you look at different recoveries, and you say that the early 1980s and the early 1990s, 2001, as we kind of began to emerge out of this tech bubble, and then the global financial crisis. You know, you look at the durations of those, orange bars, and those are the months required for EPS forecasts to recover to their previous highs before we went into recession. And you can see that in the early 1980s, that was, about perhaps 28 months. In the early 1990s, it was, 50 months. And then you go across in 2001, it was a little bit less than 40 months, and then a little bit more than 40 months for the global financial crisis. However, during the COVID issue last year, it's only taken us, really about, you could call it maybe about 17, months overall to kind of recover peak earnings forecasts. And the max decline in this one was the second greatest that we've seen, and that's in the gray, and it was about 20% decline. But what's really extraordinary here is how quickly those earnings forecasts have improved and reattained their prior highs. And continuing on the earnings thread, we can see that proportions of beats. Now we're getting some reports now here in April for the S&P 500, basically for first quarter performance. And you can see here that we're in kind of rarefied air when it comes to the proportion of companies that are beating both earnings and sales. And one could argue, a naysayer would look at this and say, well, earnings estimates were just way too low. And that's probably true. But they've been too low in a lot of other occasions too. And oftentimes you'll see periods of kind of anxiety where analysts ratchet down their estimates only to, gradually increase them as you head into earnings season. And that has actually happened this year or this quarter. But there's still a lot of optimism in the pipeline because of this very thing. Earnings are going up. Prices are going up too, but not as fast as earnings. So ironically, the price to earnings ratio of the market has actually gone down in the last couple of months, and so stocks are less relatively expensive than they were just a couple of months ago. And this is a pretty interesting development. We'll have to monitor the pace of earnings and earnings expectations. We're still expecting a fairly strong earnings year next year as well. I would have told you maybe that there's perhaps too much optimism built into it, but so far I've been proved wrong on that end. We've got a couple of charts here that kind of talk about high and low quality and then profitability. And what you can see here is kind of the interesting dynamic that's been playing out, that we've seen this cyclical rotation where there's a strong feeling of economic recovery that's built into expectations. It's obviously being channeled into earnings expectations on a forward-looking basis. And as a result of this feeling that we're kind of emerging into a new economic cycle, you can see the impact it's had on low quality stocks, which are now outperforming high quality stocks. And we've mentioned this before, that the irony is that at various times over the last 6 to 9 months, we've seen periods where companies that have no earnings at all are doing better than companies that have consistent earnings. And that's just a function of this rotation as the expectation is building that we're in this new economic cycle. And so you can clearly see how the low quality issue is playing out. Now, those stocks are outperforming right now. I do think that that's going to rotate into more of a higher quality now that we're kind of entering in this next phase or next leg of this economic recovery. And on the right-hand side, you can see that low profitability stocks are outperforming. Again, low quality, low profitability, kind of almost hand in hand. But that's clearly been the market's modus operandi over the last 6 months. But like I said, I think we're entering kind of this interesting new phase where cyclical will really take hold. You've seen some rotation into cyclical, but I think you'll continue to see that. And I think you're going to see an increase in the quality component of where dollars are going to be migrating to in the market. A quick comment on households. Bank deposits are really, really high. We've got almost 17 trillion in U.S. household bank deposits. That is obviously been impacted by stimulus, but it's been impacted by some other things too. Again, this is a kind of a global view of the U.S. household. Obviously, they're in socioeconomic layers. There are people that have been more impacted by the pandemic than others. Those people aren't doing well. But if you look at everything in the aggregate and then look at that chart on the downside, which is actually quote unquote spare cash in household bank accounts, it tells you in very plain terms that the consumer has a lot of dry powder. And this is something I've been pounding the table on over the last several months, that there's a lot of dry powder to help sustain an economic expansion, to help sustain purchasing from the consumer sector, which represents 2/3 of the total economy as we head into the second half of the year. And right now, as we see those numbers continuing to build on a sequential basis in terms of spare cash, I mean, it gives me a lot of comfort that we're going to see this transition into 2022 as well. And what this does also is it tends to reinforce the position that we're going to have some inflation that's going to channel through in the consumer sector, because as we see here, we have manufacturing choke points. Even though manufacturing indexes are really high, but we've got delays in shipping, we've got backlog of orders, we've got all of this, these constraints, which will eventually work themselves out. But in the meantime, we've got a flood of liquidity that is chasing those goods that are being constrained. And it's kind of a textbook definition of inflation that we see here. And so, again, positive from an economic standpoint, but also makes us think a little bit more about monitoring for inflation. Household spending on discretionary items. And this is, again, not the essential things. This is totally discretionary. We've had a big spike. We saw retail sales number was like almost 10% last month. Very strong number. And we're back above on this total discretionary spending number. We're back above certainly where we were in pre-pandemic, and we're accelerating with, as I mentioned in that last slide, a lot of dry powder sitting on the sidelines. So as we've seen the 10-year Treasury roll over, but really without a change in expected inflation, you can see that it's caused the 10-year TIPS yield. This is the Treasury inflation protected securities yield to go down, and it's as we've been talking about, it's a negative real yield. It's not a shock because we've had negative real yields for some time because we've had exceptionally low interest rates, and we have had positive inflation. It just hasn't been very much. But anyway, to see this TIPS yield roll over is a really good thing for the equity market. It gives you makes obviously equities much more competitive. You've got an earnings yield or even a dividend yield also on the equity market that's attractive relative to fixed income. And you can see as this number continues to trek down to the extent it stays in this area, it should be very positive for equities. Here is our 10-year yield. You can see it's rolled over. It's at a point of kind of interesting technical inversion because this is a moving average. This is a 50-day moving average, and you can see that the 10-year Treasury is down basically just under 1.6%, and it's testing that trend line. And so if it punches through, it could actually go down a little bit more notwithstanding any surprises in the data over the coming weeks. But it is at an interesting inflection, and you can see here clearly that we've kind of taken some steam off of the this dramatic rise here in the 10-year Treasury. Here's our 1-month T-bill yield, which is really interesting. So as we talk about inflation, we also have to talk about the fact that the Fed is willing to tolerate inflation for a protracted period of time, and they are doing absolutely nothing on rates on the short end. And they've telegraphed that till the cows come home. And that's very apparent here when we actually have seen negative dips in the 1-month T-bill yield. Right now, as of the close of business Friday, it was basically 0.02%, and that is minimal. That's basically zero. But this chart shows that we've seen periods where it's actually dipped negative, which is pretty extraordinary. Selected month-to-date returns. There's a lot of data here, a lot of international markets. We do believe in diversification. There's so much that's been made about the U.S. market and its, successes. I think it's important to realize too that other markets have clearly benefited as well, and there are other opportunities. And I think this really speaks to the virtue of a diversified portfolio where you do have international equities. Again, this is 1 month, and 1 month does not a trend make necessarily, but it is clearly indicative of the fact that other areas of the world within the scheme of, or the sphere of this synchronized recovery are actually benefiting. And in some cases over the last month, we've seen areas of the world that have done markets, foreign and international markets, have done better than the U.S. I thought this was really interesting going through the charts of the week, and I thought I'd include it now. So this is like reflecting the fact that a lot of people have had the vaccine, but among those who have not, this survey was given to them. And what's interesting is that you have seen we're bumping up against this population now, since we vaccinate a lot of people and we're vaccinating more and more every day, that we're finally bumping up against that inflexible part of the population, the ones that are not sure if they're going to take it, certainly the ones that might be a little recalcitrant on wanting to get it right away. And you can see that in this chart with it rolling over a little bit, but then also you're beginning to see that uptrend in this remaining non-vaccinated population of those who will not receive it. And this will be something that I think will become a story, become a headline probably during the summer, as we, question ourselves of whether we've achieved herd immunity or not. I think you could argue perhaps that it's going to take a little while, because there is a reasonable, a non, what I call a non-insignificant part of the population that either refuses to take it or they're just hesitating. And finally here, I thought I'd show this, and this is just kind of that work from home update from Statistica, and they do such a great job of providing data on this, and it just shows you that now you have a growing number of workers that want to remain remote, and then there's people that prefer the hybrid model, but there's a growing number of those who want to be remote. And what's interesting is, as we're reopening now, and some of these companies are saying, okay, well, 2022 will reopen. And a lot of people are like, well, frankly, I'll just go find another job instead of returning. And that's reflected in that second line survey, which is kind of interesting. And not too surprising as you get down into the reasons for and against it. It's pretty intuitive stuff. The reasons why you'd prefer more remote work is that you don't have a commute and there is an inherent cost savings for the gas that you're not spending to get there, or the cost of public transportation or whatever. And then the reasons against remote work is the fact that a lot of people do have distractions and tech problems and things like that. So this is a survey that was conducted really in I'd say the 3 weeks between March 17th and April 5th. And these numbers continue to evolve, and it'll be interesting to watch us as we continue to move ahead in the coming months, and certainly when we get closer to that herd immunity. Well, that's all we got this week. And on behalf of the entire BKA Wealth staff, appreciate you taking the time to spend with us this week. Hope you've enjoyed Charts of the Week for this week. Please feel free to reach out if you have any questions or comments. Hope you have a safe week. Hope you have a productive week, and hope to see you again next week. Take care.